So we will begin the fourth event of the Rio and Leeds Bridge seminars. The event today will feature here on my left and probably your right, Professor Carsten Kohler from Leeds University Business School, and here on my right, Professor Norberto Montani from the Institute of Economics of the Rio de Janeiro Federal University. And these two discussants will discuss today a common question, which is, what are the impacts of interest rates on the financial and real cycles? It's a big question, and we have a lot to discuss, and we start now with Carsten. Please, the floor is yours.
I'm going to put on my timer. Yeah, thank you so much for this invite. Special thanks also to Gabriel and Bianca for organizing this series, and to Norberto for discussing with me. Looking forward to hearing your thoughts on the topic. Yeah, I thought my plan was to talk a little bit about my past research on financial cycles.
No. If you could speak out a bit louder. Yeah.
So I'm going to talk a little bit about my research on financial cycles in the first part, and then in the second part, I'm going to try to share some thoughts on the role of rising interest rates on financial cycles in the UK. So a little bit looking a little bit into the more recent developments and what that may mean for financial cycles or business cycles in the UK. Okay, so starting off with my own research on financial cycles or financial and real cycles that I've done mostly together with Engelbert Stockhammer and Rob Jump. So we were interested in, I think, investigating two aspects of cycles. So on the one hand, the question of endogenous cycles, that we wanted to, in a way, find an empirical approach to analyzing or investigating this idea of endogenous cycles that is quite prominent in heterodox business cycle theory. So I'm going to say a little bit about this distinction between endogenous cycles and exogenous cycles. And then the second idea that we were interested in was this idea that the idea of financial, what we call financial real cycles. So basically business cycles that are driven to a large extent by financial variables, or the interaction between the financial sector and the real economy. So yeah, these are the two main ideas that I want to talk about a little bit and explain a little bit the research we've done on this, and then I'll talk a bit about the UK experience. So first of all, in terms of this distinction between endogenous versus exogenous cycles, so coming from the more heterodox tradition when it comes to thinking about business cycles, we like this idea of endogenous cycles. And the idea behind endogenous cycles is that the business cycle, which is sort of broadly defined as cyclical fluctuations in, say, real GDP, is not just an outcome of a sequence of stochastic shocks that hit the economy, like, I don't know, the Russian invasion of the Ukraine and what that does to global energy markets, or the pandemic, or perhaps let's say certain fiscal policy interventions that were just driven by idiosyncratic motivations of policymakers that wanted to make certain gifts to the voters shortly before an election, things like that. So instead of this idea that the business cycle is only driven by these exogenous shocks, heterodox idea would be that business cycles have an endogenous element in the sense that the economy exhibits certain intrinsic mechanisms that lead to booms and busts, regular booms and busts. And these booms and busts are not just the outcome of these exogenous shocks or exogenous policy interventions, but they have to do with the way the economy operates. So that's the idea behind endogenous business cycles. And this contrasts with other business cycle theories that you find, for example, in mainstream macroeconomics. One influential business cycle theory in mainstream macroeconomics is real business cycle theory, where it's all about exogenous shocks, essentially productivity shocks. There's this idea that I guess in the end it comes down to certain technological innovations that are then just modeled as a shock to total factor productivity, and this changes the permanent income that households can earn, and that leads to adjustments in their behavior, and that's essentially what drives any kind of fluctuations in macroeconomic time series. So that would be the exogenous business cycle approach, and that contrasts with this more endogenous cycle approach that we find in heterodox macroeconomics. I think that the idea of endogenous cycles doesn't rule out the role of shocks. I don't think that anyone would claim that, the pandemic or I don't know, shocks to commodity markets due to geopolitical events do not have effects on business cycles. For sure, exogenous shocks matter as well. But the endogenous cycle view would be that you would have fluctuations in economic activity even without these shocks. And these fluctuations are endogenous and are linked to the way the economy operates. Okay, so then a few more words on what drives these endogenous cycles. There's a variety of different theories of endogenous cycles in heterodox macroeconomics. One prominent version is the Goodwin model of class conflict. I'm sure many of you have heard about that. So there's this idea that the business cycle is essentially driven by class conflict between workers and firms. The workers manage to raise the real wage when the economy is booming. So then the idea is the employment rate goes down. That increases the bargaining power of workers. The workers manage to enforce a higher real wage, and that squeezes the profits of firms. And it's assumed that investment is driven by profitability. So as profits are squeezed, firms reduce their investment, and that then triggers a downturn in the economy. And as a result of that, the unemployment rate increases, and that lowers the bargaining power of workers. And this allows then profits to be restored. And this then prepares the ground for a new cycle. So that's this Goodwin model of class conflict as a driver of business cycle. That's one example of a prominent endogenous cycle model within heterodox economics. Then there's another prominent model that's coming a bit more from the post-Keynesian tradition that was proposed by Nicholas Calder. You can also find, I think, another model that is sort of similar in spirit in John Hicks, where basically the idea is that the goods market is intrinsically unstable. So once the economy embarks on a boom, the firms tend to overinvest, if you like. They tend to invest even more as soon as their sales go up. And because economic activity is demand-driven in these models, the additional investment by the firms constitutes another boost to aggregate demand. So basically, you go into almost like an explosive path because, aggregate demand sort of sustains itself. The firms sell, their sales go up, they invest more, that creates more aggregate demand, so they sell even more and they invest even more, and so in this way you get onto this unstable trajectory. And then there's this idea that there's, I guess, at some point certain supply constraints that then curb this unstable dynamics in the goods market. So this could be because the economy reaches full employment, or because somehow the firms accumulate too much capital, and at some point they can't. I guess they can't really sell all the goods that they've produced because they've accumulated too much capital during this excessive boom period, and this is then what leads to the bust. Okay, but the business cycle theory that we were mostly interested in our research was the Minskian business cycle theory, where the idea is that these endogenous business cycles are strongly influenced by what's happening in the financial sector. And the idea is that during economic booms, in Minsky's initial narrative, it was mostly firms, corporations. They would take on more debt. They would become more optimistic and believe they could manage higher leverage ratios and would be able to repay their debts in the future due to higher profitability. But so the idea is that the firms push this too far, if you like. In these optimistic episodes, they take on too much. They take on a lot of corporate debts. Their balance sheets become more fragile. And the idea is that this goes up to a point where at some point the firms, or potentially also the banks, realize that they have taken on too many financial risks. And then some firms will start to reduce their debts, or potentially the banks will constrain further credit to the corporations, and that then forces these corporations to deleverage, and that what turns this boom into a bust. And the bust is then characterized by firms and potentially also banks trying to deleverage, which at the same time contracts aggregate demand. That reduces profitability, and that makes it actually even harder for the firms to repay their debts. And so that then leads to a deep bust. So in Minsky, there's this idea that the endogenous business cycle is, it's strongly connected to what's happening in the financial sector. And the term that we used in one of our papers was financial real cycle, a financial real cycle. So an interaction between the financial cycle and the real cycle that gives rise to these fluctuations. So we then wrote a paper that came out in 2019 in the Journal of International Money and Finance, where we try to investigate this concept of the financial real cycle econometrically. And so the idea was to say, okay, according to this Minskian story, what we should observe in the data is that periods of economic expansion lead to an increase in financial activity. So that could be, for example, reflected in an increase in corporate debt. And then this increase in corporate debt should have a negative feedback effect on the real economy, on the business cycle. So that would be the idea behind the financial real cycle. And in this paper, we developed a very simple approach using vector autoregressions to estimate econometrically whether this interaction between the financial side of the economy and the real side of the economy is present. So we looked at a number of financial variables. In that paper, we looked at interest rates, corporate debt, and household debt. And we found that for Australia and the US, we found evidence between an interaction mechanism between the business cycle and interest rates, whereby the increase in economic activity would push up interest rates eventually, and that would then have a negative feedback effect on economic activity. And for Canada and the UK, we found evidence for such an interaction mechanism between corporate debt and economic activity. So during economic booms, corporate debt would go up, and then corporate debt would have negative feedback effects on GDP. What is interesting is that we did not find evidence for such an interaction mechanism with household debt. So we only found some evidence for interest rates in corporate debt, but not for household debt. And we looked a little bit also at the frequency of cycles in these financial variables and in GDP. And we found that cycles in household debt tend to be much, much longer than cycles in GDP. So for household debt, we found cycles between 14 and 17 years. And for GDP, we only found cycles with a frequency between 9 and 12 years. So it seems that the household debt cycle is sort of a bit of a different animal from the cycle in GDP. And yeah, we felt that this analysis, where we only look at two variables and how they interact, didn't really allow us to fully understand how cycles in household debt work, but they may be more applicable to cycles in corporate debt and in interest rates. Okay, I'm gonna wrap up. We can also talk more later about the UK, I guess. But maybe just a few words, and then maybe we talk later about the more recent developments. But in the more recent research we've done, we've started looking a bit more, in particular, at household debt and house prices, because we felt that this part of the analysis wasn't so satisfactory in our paper in the Journal of International Money and Finance, because sort of our empirical results didn't seem to confirm that there was a key role for household debt, but at the same time, it was kind of obvious that for some countries like the US and the UK, household debt plays a big role for the business cycle. So more recently, we have worked a bit more on that, and we think that a key variable that is important to understand how cycles in household debt interact with the business cycle is house prices. And so in more recent work, we look a little bit at house price cycles across countries. And the way we think about it is that some economies tend to have very speculative housing markets where house prices tend to follow cyclical patterns, and this then can affect it can then have impacts on the financial cycle in the sense that if you live in a housing system where house prices tend to have strong cyclical dynamics, often that also invites households to take on mortgage debt to buy houses and benefit from capital gains in the housing market. So we think that house prices are a key driver of cycles in household debt, and they may then also affect the business cycle, but this typically happens at lower frequencies. So this can take quite some time for a boom and a bust in the housing market to play out. A boom period can take 10 years or something like that, and in between you can have shorter business cycles. So it's not that the business cycle is sort of completely determined by what's going on in the housing market, but at certain points in time, there can be sort of a coincidence where the housing market crashes, and then the business cycle also goes down. Okay, but maybe I'm just going to stop here for now. We can talk more about housing perhaps later on. But yeah, I'll stop.
Okay, Carson, thank you so much. This was actually an excellent way to lead off discussions. And I think there's a good segue here with Norberto, particularly you mentioned a lot of issues around Minsky theory and household debt, but I'll leave these comments to Professor Norberto now. Thank you for that.
Thank you, Gabriel. Thank you, Carson. And thank you for all who is watching us and for all those that are present here. It's a pleasure to talk to you. Well, I'll try to make a more complementary comments on that question. And from the onset, I would say that I would say that I don't have a lot to talk about real cycles at the end of the day, because our research here it's more focused. And when I say our research and talk about our group here, Gabriel and Paula and everything that we are developing in our research agenda, is more focused on the financial cycles. Not because we like it, but because we think that it's more, it's the core of the discussion that is missing nowadays. So I would say that I would guess my first comment would be, well, I think that the current discussions on interest rates are misplaced, but when you look at investment, okay, investment is determined by the interest rate. Not really. It's important, perhaps have some importance, but well, you know that, well, I have a whole conference last week here in Rio, and so I would, I know that this will be recorded to YouTube, so people who were not able to attend in person will have the videos at the YouTube and so on, and the international workshop on demand-led growth. So also consumption, as Carson already pointed out, is more, sometimes you don't have these direct effects of your interest rates. We talk about government debt service is also a bit complicated. When we talk about inflation, well, we had a huge discussion on inflation on that workshop as well. So we think we can move to another subject in order to understand the effects of interest rates in our economy. So Carson already pointed out some features of the financial cycles. I will just recall the mainstream literature on that. First, that mainstream literature discovered or rediscovered financial cycles after the great financial crisis of 2008, sorry. But actually they have some thoughts that are worth mentioning. The first, that financial cycles, and I am quoting the works of Drama and others, and Claudio Borre from the BIS, which are two references on this. And the main conclusion is that, okay, financial cycles have some features. It's more based on credit, on loans. It has, as Carlos has pointed out, lower frequency. Well, we can see larger swings along time. You have the peaks of financial cycles associated with financial crisis, and also if you look at these credit conditions, you can have some leading indicators on that. And these cycles are very sensible to different policy regimes. And so from that, we can take that interest rates at the end of the day, when they influence and way they govern asset prices, credit costs, and financial stability. And I will get back to that point with more detail. They can have a direct influence on how the economy works. So we are trying here in our research agenda at the Observatory of the Financial System, we are trying to understand and advance a Minsky approach to this. And at the end of the day, we're discussing the financial behavior of different economic units, but interested in the macroeconomic consequences of that. So as Carson was saying, Minsky focused too much on non-corporate, on non-financial firms, on corporate firms. But what we try here in our research is to extend this approach to other types of agents. We extend this approach to households, extend this approach to banks and to financial firms, properly saying, and most of you probably already heard a lot about the Minsky financial stability hypothesis, and which poses that stability is destabilizing and everything that Carson already mentioned. But we think that there's another point on this which sometimes people miss out, and that's why we have this whole agenda of research being developed here, because these points that good times will plant the seeds of crisis, endogenous, and so on. Everything that at the end of the day, the financial cycle doesn't take place in a vacuum. So we need to understand the institutional setting. We need to understand financial regulation. We need to understand a lot of stuff that is normally under the cover on this discussion. So when we're calling the global financial crisis in 2008, we would remember that it was the poster figure of the financial stability hypothesis, the Minsk moments, and so on. But even some fellows of the Minskian tradition would say that the financial stability hypothesis perhaps does not quite describe what happened in 2008, because at the end of the day, the subprime loans scheme was a Ponzi scheme from the beginning. It was not endogenously created. I would disagree with that, but anyway, I have ie-ufrj saying that it's not quite the case. It's not the traditional Minskian history. It's the you had some institutions, some fragility that were at the onset of the crisis, and fragility did not read increasingly, progressively, but it was huge from the beginning. So I will add some grain of salt to this interpretation, but anyway, this points out that financial regulation matter, financial practices matter, financial standards matter. As I said, those cycles do not take place in a vacuum. So at the end of the day, the message is institutions matter, and that's why I study financial regulations, not because I like it, because it might be very boring. Yeah, you all know this, but it's because we understand that this is important at some point. So, and from this slightly different starting point, we try to understand the micro, the individual behavior of economic actors. So we are doing some research on households. Me and Paula and Carmen Feijó, also from UFRJ, we're working on this. We worked with financial fragility of large firms. I had a PhD thesis that was defended last month by Marcos Fernandes about this theme, the interaction between financialization and financial fragility for large Brazilian firms. We have some discussion on small and medium enterprises, the work with Luca Borigan. We have also discussion on the financial system, which is basically the subject of Gabriel's PhD thesis. So we're trying to look from these perspectives, the different perspectives, how we can build a financial structure to understand what happens in the whole economy. So a few more thoughts, I think, and this was an approach that was prompted by the COVID-19 crisis, because, okay, you're already working with those themes, but when the pandemic took place, we are in the middle of something that we think the theory was not set to understand. I think that the theory was not able to understand some basic points that were unfolding at that time. And we think, well, for instance, we always argued that the COVID-19 would bring a massive increase in financial fragility. Was that true? Partially, yes, but when you look at the data, well, big companies are sitting on a pile of cash. So they're pretty good at it. Yeah. And if you look to SMEs, to households, in Brazil, at least, in Brazil, it's a kind of conundrum. It's the first crisis that you have credit increasing in the middle of the crisis, and we have delinquency rates getting down in spite of everything that happened. Of course, we had some policy on that. Of course, it was the Minskian big bank or big government, if you want to use that terms, that helped to understand the figure. But in the first moment, it was a kind of conundrum. It was not clear what was happening at that point. So, despite the massive deterioration of balance sheets at that time, actually we are able to manage and navigate through the crisis without much trouble. But now, perhaps, we are starting to see, we are starting to pay that bill, and not me, not you, but specific actors in many households and small and medium enterprises in Brazil. And this has a lot to do with the behavior of monetary policy in that setting. And this is one point that here in Brazil, well, I don't know in the UK how the discussion is unfolding there, but here in Brazil, the last month were marked by a dispute among the central bank chairman, Roberto Campos, and the president Lula and all the economic team of the new government. It's a dispute about the basic interest rate, which is now about 10% in real terms in Brazil. And of course, we have all those discussions about, how interest rates are large in Brazil. It's a historical feature of the Brazilian economy and so on. We're not dive into that now, but we can talk more about this later. But at the end of the day, we saw monetary policy in the aftermath of the COVID crisis, basically prompting another round of increase in financial fragility, but a selective one. So as I said, this interest rate burden is not equal to everyone, but has different impacts in concentrated low-income households and SMEs. So what was neglected in that discussion here in Brazil was that monetary policy has also these impacts on financial fragility that are not taken into account when trying to combat inflation as the main target of monetary policy. So I would say, well, of course, interest rates have distributive impacts, but we need to think about financial fragility as it is one of the core impacts that are neglected in this discussion. And I would say that at the end of the day, this will lead us to a discussion which has to do with how we set the institutional setting of monetary policy, the institutional framework of monetary policy. And I would say perhaps forget inflation targeting and let's talk about a different thing. Let's talk about financial stability being the target of monetary policy, but I know that we still need a lot of research on that, and this would be, I would say, a project for life in order to understand how these impacts can be traced. How can we establish a different framework in comparison to what we have now? And why I'm saying that is not because of course, if you are a mainstream economist, you will say that I am saying that I'm not saying that I'm talk a lot of stuff. But at the end of the day, when we started to discuss what are the impacts of interest rates on prices, it's not that different to understand what the impacts of interest rates are on financial fragility. You don't have good measures. You have a very limited evidence on the actual impacts of interest rates on prices. And I would recall again the conference that we have here the last week. But basically, we're raising interest rates all around the world, and inflation is there. Now in Brazil, it's a bit better, but everyone would say that with the foreign exchange rate in our side, and with some of the bottlenecks being overcome, one would expect that. But we have more structural discussion as well regarding inflation, the green transition, and so on. So perhaps we need a different framework to understand how interest rates and financial cycles would be manageable by the monetary authority. So I'll stop now with this message, and then I can get back to some of the points of that discussion.
Thank you. Okay, another excellent way to start the conversation. I think we're gearing towards something like monetary policy beyond inflation, in a sense, and I'd say that's a big discussion for the moment. At this point, we'll open the floor for questions, either here in presence or online. And I already see we have some questions on the chat of our meeting here. I would like to read the first. I guess we have 3 comments or questions. I read them, then pass on the floor to you. I know we have some outstanding questions as well to talk to Carson about our situations in the UK, and we would like to talk to the 2 presenters about methods. But first, onto the questions that are on chat. The first one is from Nicholas, a student here in the Institute of Economics, is how would the Minsky endogenous cycle unfold in an economy with an underdeveloped or small financial system? In such a scenario, to what extent does the real side hold influence? And then a second related question is, does an economy with a low monetary hierarchy amplify the volatility of the, in parentheses, endogenous, close parentheses, cycle? And I read in a row the comment from Professor Luis Fernando de Paula here from the Institute, who we feature in a previous seminar here. If anyone is interested, the video is available online. And Professor Luis Fernando said on chat, very interesting presentations. I would like to hear from Carson if he considers in his empirical behavior of the banks, that is the change in their state of expectations on the credit supply and consequently on in stimulating or not stimulating agents' spending decisions with an impact on business cycles. So if I understand, if there is in your empirical assessment some matter about the change in expectations from banks particularly. If I just make a quick comment, if people on the online part of the meeting want also to ask questions verbally, I just ask to raise their hands because we have to edit a little bit of the sound configurations here, and we just need a minute or two to respond accordingly. You both got the questions. I know, Carson, would you like to go first, following the order? Okay, thank you.
So, yeah, thanks for the questions. I think the first one was about economies with relatively small financial systems. To what extent financial cycles play a role for the business cycle in those type of economy. I mean, I think the short answer is I'm not too sure. I guess it depends a little bit on how small the financial sector is. So my understanding is that in many Latin American economies, I think financial stability matters a lot for the corporate sector. In the sense that you have a significant number of relatively large firms that issue bonds, for example, also in international markets, sometimes also denominated in US dollars. So, that corporate indebtedness in foreign currency can be a big source of financial instability in emerging market economies, but I suppose that for some sub-Saharan African economies, this is not even relevant because you don't really have a large domestic corporate sector that would borrow in international markets. So I suppose that if you wanted to study business cycle dynamics of those economies, you would look at different mechanisms. But yeah, that is simply not my area of expertise. I think one would have to study in more detail the role of the financial sector across different economies. Maybe this is a good opportunity to highlight a little bit the cross-country differences. I think I don't think you can apply a generic Minskian theory of financial cycles that then works for all countries in the world. I think every country or certain groups of countries, they have their specificities and institutional specificities, and that shapes the role of financial cycles for business cycles. So, for example, for economies like the US and the UK, I think the housing market plays a big role, and we'll talk a bit more about that later. Whereas, yeah, for example, for Brazil, this may not so much be the case, or even for Germany, where I'm from, I don't think that the housing market plays such a big role because mortgage credit is just not that widespread. So if there is financial instability, it's probably more in the corporate sector or maybe in the banking sector. So I guess it's important to take a close look at the domestic institutional structure. And then maybe combining that with the second question on the currency hierarchy, yeah. So I think for economies that occupy a lower position in the international currency hierarchy, I think that open economy consideration play a bigger role for understanding financial cycles and business cycles. I mean, I mentioned the example of, for instance, corporate bond issuance in dollars. That can be an important source of financial instability for economies that cannot borrow in domestic currency abroad. So there, I think the position in the currency hierarchy plays a role. I also think that when it comes to exogenous factors, as opposed to these endogenous cycles, I presume the currency hierarchy plays a role, because I think economies that are further down the currency hierarchy tend to be more sensitive to global financial shocks. So, for example, when there's a shock in global financial markets and investors reallocate their funds into US dollar assets, that can lead to currency depreciations and increase in interest rates in countries in the global south. And that can then be a source of financial instability. But for me, that would not be so much an endogenous financial cycle. That would be more an example of exogenous factors being a trigger of financial instability. I do have another paper with Engelbert Stockhammer that came out last year in Industrial and Corporate Change, where we look at exchange rate cycles. And that paper was a little bit of an attempt to apply this sort of endogenous cycle approach to emerging markets. And there we argued that there could be such a financial real interaction mechanism between the nominal exchange rate and the business cycle, in the sense that during periods where the economy booms, the current account position tends to worsen over time, and this can have negative feedback effects on the exchange rate, in the sense that the exchange rate may depreciate eventually because of the current account deficit, and then the depreciation of the exchange rate could then drag down the real economy through contractionary effects from, for example, foreign currency debt. So I think there is certain financial real interaction mechanisms, endogenous financial real interaction mechanisms that are also applicable to emerging markets, and there I would say the exchange rate can play a key role. But for me, this is also compatible with more exogenous events as well. So I would not make the claim that this is sort of the only mechanism that drives business cycles in emerging markets, but I think that's one mechanism that may be relevant for some of the fluctuations we find in GDP, besides other things. There was another question on bank expectations, but I don't know, maybe Norberto, maybe you want to come in and then I come back to that question later.
Yeah.
Okay. And just a quick comment, because we received a recent question also from Professor Luis Fernando. He commented your shirt, very nice, and nice album. And he would like to hear more about monetary policy in Brazil. And he comments that central bank manages a very high interest rate. There's a huge distribution effect for the renters, but low impact on fragility of the banks. And he asked if you could please explore these linkages as well. And then we'll return to Carson.
Yeah, well, thank you for the questions. I would say I don't have a lot to add regarding Nicholas' questions, because I think it's more or less what Carson set out. It's when you have a very restricted or small financial system, at the end of the day, it does not mean that it will not have that influence of the financial fragility and so on, but it takes place in different ways, basically on the external constraint. It's not, I think we do agree on that. And of course, if you are in a lower monetary hierarchy regarding your exchange rate and so on, you probably would be even more subject to global movements and the global financial liquidity cycle. So, but I would say that it's very relevant to understanding that in these countries, and Luis Fernando has some recent work on that, on these smaller countries, you have different mechanisms, but you still can apply some of the reasoning that we are talking about here. And of course, Brazil is a large economy, it's a large country, and it's very connected, very well connected to the global financial system. But if you look to Argentina, you see, for instance, how an underdeveloped financial system and underdeveloped for current standards, because in the beginning of the century, it has the largest financial system in not Latin America, I will not say that, but in South America for sure. So we can see now how the dollarization, how the external constraints played a very relevant role in this endogenous miskin cycle. So we need to add these variables into the history. Regarding the monetary policy in Brazil, I would like to say a few words. The first thing is that I would like to point out is that mainstream economics usually talks about monetary policy from a technical perspective, saying that, okay, at the end of the day, the policy rate will be set based on technical standards. So we need to understand how this technicality works in practice, and disregards the political economy behind the policy setting at the end of the day. So the first thing I would say is that we cannot neglect this political economy aspect of monetary policy, actually of every economic policy, but monetary policy. And interest rate setting would be one of the main disputes now. I already talked about the Brazilian case this year, but if you look into historical standards in Brazil, since the real plan, we basically have the same feature of very high interest rates at the end of the day, and it is a byproduct of the institutional setting of monetary policy that we have here. In practice, we have one of the main stringent inflation target regimes in the world, and we can see that you have only a 1 year horizon. It has changed now, but we still need to understand what these changes will bring for our monetary policy management. But we had 1 year horizon, we used the full CPI, not the core CPI. We had small tolerance intervals, and in the last decade, we moved the targeting from current inflation to inflation expectations, which is core to understand why now we have a 10% per year real interest rate in Brazil when we have inflation which is below the target, and the central bank is struggling. No, I will not cut the interest rate because I'm interested on the expectations of future inflation. So this was a change that took place in 2015, 2016, that was maintained over time, and now we still have, we add to this equation targets which are not compatible to historical standards of inflation as well. So 3% inflation in Brazil. I don't know if you have this data in my mind. We will name 1, 2, 3, 4 years that we had this in the last 50 years of our history. So, well, with this in mind, I think that we have a very conservative way of setting interest rates from the onset, from the beginning. So we will never be able to see international convergence of interest rates in Brazil with have this kind of regime. And we also have different impacts that this has on our economy. And I would like to say a word about the impact of this on financial fragility of households. So now the government was also planning for a program called Desenrola. It will be, in a very bad translation, untangle. And if you have a better, which is untangle yourself, untangle from the indebtedness situation that you have. So it is a relief program based on the renegotiation of household debt. But at the end of the day, it is a relief program. It will just will help in the short term. But if you have monetary policy playing against you all the time, we'll need Desenrola 2.0, Desenrola 3, 4, 5, and so on. So this is very relevant. And this is a distributional effect, which is not, as Luciano said, it's not in favor of renters. Okay, it is as well. But this is against the Brazilian low-income households, and we need to have this in mind. And the limited impacts on the financial fragility of banks is related to the fact that the banks, at the end of the day, they can manage their liabilities and their assets. And well, in Brazil, if the interest rates go up, you call your treasurer and say, well, let's buy some bonds, and more or less it can equalize the rates that you pay on your asset side and the rates that you pay on your liability side. It will jeopardize your profits in the short term, but in the medium term, more or less, you can manage it to reorientate your loans and to reprice everything in order to achieve a more profitable situation. So in terms of financial fragility, the impacts are not that great, but we should recognize that they have an impact that is usually on the not as expected by even heterodox economists. They say, oh, okay, you increase the interest rate, banks will earn more. It's not that way in practice. In the short term, you have some influence and negative impact on profitability, but at the medium term, usually the banks are able to navigate this. And we also had a paper which is actually it's waiting for being published for more than a year. So I need to email the editor of the journal, but we had a paper with Paula Luiz Macaíba, which is also participating today, and Dalton Boechat, where we looked to the profitability of Brazilian banks and saying that It can rain, it can make sun, it can make everything. You can have a huge climate crisis. The world could be on fire. That Brazilian banks will be earning a lot of money here due to not only to the level of interest rates, but also because of the structure that we have here in our financial system. So we need to update this paper because we're trying to discuss the previous movement, the movement in which Brazilian interest rates were getting low, and we have 5 years of decent interest rates here in Brazil, but it is an outlier in your history. So now we need to update that paper to discuss now that the interest rates went up again. What are those impacts? And thanks to Luis Fernando to remember and this idea that we need to develop in next research.
Okay, thank you very much. We have another round of questions. And if you allow me, I would like to ask a question to Carsten, and because you mentioned this, so if you could also add some comments about the let's say monetary policy situation in the UK, because that would be interesting to compare with how we are here in Brazil. Yeah. But we also have two questions from the chat. One is from Felipe Munoz, a student from Leeds University, and he has a question regarding interest rates and the necessity to meet Paris Agreement targets. He comments that it's likely that decoupling projects aiming at mitigating climate change will need a financial stability in order for those projects to become feasible, or in other words, to become profitable, as he says. And at the minute, economies around the world, except for China perhaps, cannot offer financial stability and low interest rates at the same time. He would like to hear from both presenters whether they consider there is a prospect, even if something embryonic, of the necessity of a new era of low interest rates in the near future. And we also have a questions from Luz Makaiba, who very kindly congratulates the speakers and the moderator here who's here. And he has a question, which is the last global financial stability report by the IMF suggested that monetary authorities could face a complex trade-off between financial and inflation stability when setting interest rates in the near future. And he asks to both speakers, if considering the recent banking crisis in the US appears to be under control, do you think that this potential trade-off is no longer relevant? Also following the order, Carsten, I'd like to open the floor for you.
Yeah, let's talk a bit more about the role of interest rates and monetary policy in financial cycles. So I think, Roberto, if I understood you correctly, you would make the case that interest rates actually don't matter that much, or maybe their role has been overemphasized a little bit.
To the real cycle.
For real activity. Yeah, I think that's also sort of my reading of some of the empirical joint investment, for example, where interest rates tend not to have very strong effects on business investment. I think I think where interest rates can have significant effects on real economic activity is really in economies where mortgage debt plays a big role. So maybe that brings me a little bit to the UK, where the Bank of England has raised interest rates since the end of 2021 quite substantially. They were at 0.1% for I don't know, a decade essentially, or more than a decade after the global financial crisis. And now they have raised them up to 5%. And actually tomorrow the Monetary Policy Committee is gonna meet again and will probably announce another raise to 5.5%. So there's been quite a substantive increase in monetary policy rates in the UK in the last 2 years. And I think the reason why this could have substantial effects on the business cycle and the financial cycle as well is because of the key role of mortgage debt for the UK economy. So UK has a relatively high home ownership rate, 65%, something like that. So lots of people in the UK do own homes that are financed through mortgages. Most of the household debt in the UK is also mortgage debt. So more than 90% of household debt is mortgage debt. So relative to consumer credit, mortgage debt is much more relevant. And so people often take out fixed rate mortgages where the interest rate is maybe fixed for 2 or 3 years, and then after that the interest rate becomes variable and is determined by the bank. So now the interest rate on these fixed 2-year fixed rate mortgages has gone up to 6.6%, which is quite a substantial increase over the last couple of years. And so for those households that will switch towards a variable rate, they will quite suddenly face much higher monthly interest payments. And that in itself, I think, can have contractionary effects on consumption if simply a large number of households faces a substantial increase in monthly interest rate payments that will require them to cut back on their consumption. Then you also have a fair number of households that have taken out these buy-to-let mortgages, where you basically take out another mortgage to buy a second property that you then rent out. And because a lot of the properties that are rented out are owned by landlords that are indebted themselves, they try to raise rents now. I mean, I can speak on my own experience because they essentially roll over the higher mortgage rates onto rents. So that eats into our monthly income. So I think there's currently a lot of households that are that will have to cut back on consumption to face these higher costs related to higher mortgages. So I think for economies where mortgage debt plays such a key role, I think interest rates could potentially have stronger negative effects on the real economy compared to economies where maybe household debt is not such a big thing, and where interest rates do not directly impact consumption demand that much. And then the second mechanism that is important for an economy like the UK, where debt-financed housing plays such a big role, is then the role of house prices. So now, because of these higher mortgage rates, a lot of potential first buyers of houses decided to postpone their house purchases. So the transaction volume in the housing market has gone down, and nominal house prices have also fallen by almost 4% now compared to last year. And in real terms, house prices have fallen in the UK now by about 10%. So it's quite a substantial fall in house prices already. And people will expect prices to fall even more. Some real estate companies expect house prices to fall by 25%. So now it's actually a really bad time to buy a house, because you're going to pay a fairly high mortgage rate, and at the same time you can expect the value of your house to go down in the future. So a lot of people hold back with buying houses, and that amplifies this fall in house prices. And at the same time, for those households that already own a house, that means they undergo a capital loss if their house prices fall. And if they have to refinance their mortgage over the next couple of years, they may face tighter conditions for refinancing their mortgage, because the collateral value has fallen. At the same time, mortgage rates are higher because of the increase in central bank interest rates. So I think that it's a relatively bad situation right now in the housing market, with some similarities to what you had in 2006, 2007 in the US. So I think for economies that are that sensitive to what's happening in the housing markets, a rise in policy rates can potentially trigger a downturn in the financial cycle, which then can also lead to a recession. So I think that's an interesting lesson there from the UK. But I think it also highlights the fact that there can be quite substantial differences across countries, because obviously not all countries home ownership and mortgage loans play such a big role. But I think this whole experience, I think, I would say, supports what you say about monetary policy and sort of the objectives of monetary policy, that if you have monetary policy only focused on managing inflation and not paying attention to the side effects of such an anti-inflationary monetary policy, you may end up with a monetary policy that is very pro-cyclical, because it just basically tricks a financial bubble that has built up without the central bank really paying much attention to it. And then it unintentionally triggers this downturn, just for the sake of signaling to markets that the central bank is committed to price stability, while the actual instrument, the main instrument to maintain that price stability, is a pretty crude instrument. I mean, we know that it's not, interest rate setting is not particularly effective in actually bringing inflation towards its target. So in the end, you achieve lots of things, but not what you actually want to achieve by focusing your monetary policy on inflation targeting only. And so, yeah, for me, I think the current episode really underscores this insight that this division of labor, where the central bank exclusively focuses on inflation targeting, and all other macroeconomic objectives are kind of sidelined, I think it's not a very effective way, I think, of arranging macroeconomic policy. So yeah, I agree with that.
Yeah, thank you. Thank you very much, Carsten. And now, Roberto, please.
I'll try to keep it brief, so no, but one thing, when you're talking, I always remember about monetary policy. I always remember the next expression, great moderation. I love that expression because okay, we're in a new era of low interest rates, of low inflation, of small volatility of GDP, and then we just faced one of the largest financial crises in the history. That I would say we cannot recover from that, and now we have different challenges that we need to face. But anyway, so the first question is of Felipe Munoz. Felipe, thank you for a question. I'd like to just say a few words on that, because at the end of the day, I agree with you that only China managed to deliver financial stability with low interest rates. But even in China, we are seeing some problems of financial fragility. Remember that what happened last year, at the beginning of this year. I'm not seeing last year. Yeah. Okay. So in the housing market of China. Yeah. So but I would not say that we need a new era of low interest rates for promoting the green transition that we need. I'll be more radical. Perhaps, okay, it could help if it would be able to help in managing the political economy of having large public investments for the green transition. And I would say that if you read all the discussion on private investments and so on, we need low interest rates to foster private investments that will bring about the transition or the mitigation that we need to face climate change. I would say, well, it's capitalist. So I think we need more. Perhaps we need public investments. We need not the type of policy that has to do with the budget, not with interest rates. But if low interest rates help in negotiating this with society, and I'm taking a more pragmatic view here, not because I do think that you need low interest rates for public debt sustainability and so on, but if this would happen, the political economy issue, it will be welcome. So, and if, especially because of probably we'll need some changes in the tax structure that will not be easy to implement. We are discussing a tax reform here in Brazil nowadays, and we see how difficult this could be. And the second point of Macaíba, sorry, and I forgot one thing. And we also have another thing, which is perhaps with the green transition, we'll have some inflation, have higher inflation standards. Our colleague here from FRJ, Eduardo Baixo, published a blog this week on the monetary policy blog, talking about inflation regimes in this new era of green transition. So perhaps saying that, well, we had this COVID inflation, and now probably we had, of course, which was boosted by the Ukrainian war, but probably now we'll have a regime of higher inflation. So if we keep the institutional setting as it is nowadays, we'll need to live with higher interest rates in the near future, and this would compromise private investments and so on. I would say, well, remember the first point that I made, but with this, in the current regime, probably we will have also this greenflation issue that we need to, and if we need to use interest rates for that, it will be bad as well. So I think at the end of the day, and answering also Macaíba's question regarding the trade-off of inflation and financial stability, I think that this is not quite a trade-off, but it's a trade-off for the mainstream guys. That I remember a seminar or conference, I don't remember exactly, organized by the Central Bank of Brazil in 2014. And I remember that when a guy from the IMF was there to deliver a message. The message was inflation is a matter of monetary policy, interest rates, financial stability. Okay, monetary policy has some impacts, but it's a matter of macroprudential policies. Don't use interest rates to manage financial stability. And I could not disagree more. I remember the name of the guy, is Stein Classes, which is every year, I think he comes to Brazil to that conference of the central bank. He was there this year. I don't know if you remember, Marco, but he was there this year. And I would say it's not quite a trade-off. It's a trade-off in the terms that people are putting it now. But the point is that you're raising interest rates and you're not achieving a control of inflation. Inflation, okay, we have the peak, and now it's getting a little better. But just because you are overcoming some bottlenecks, and okay, you have also all the discussion that have on inflation and alternative policies that you can put forward to deal with this. You had Isabella Weber here in the last week, but we also have a set of alternative policies that we can discuss, which does not have nothing to do with the management of interest rates. So I would say that we need to challenge this trade-off and try to set a new basis and a new framework for monetary policy. And I would agree that perhaps we do not have now a very clear picture of what would be this alternative regime. But I think we need to put our bets on developing this type of discussion of regime of policy that can guides us in a more favorable way in the near future.
Thank you. We have a last comment from the audience here. Paula, would you like to add?
Você consegue sentar aqui? Você consegue sentar ali?
I was hearing Carson talking about England and just realized how Brazil is a very challenging case always. I think we have been seeing a very increased, very important increase of the participation of households credit in Brazil. Now we can say that in terms of the impacts on the results of banks, household credit has been more important than corporate credit. It's really incredible. And another point is mortgage credit is not so important here as it is in many countries, and it is in England, as mentioned. We have also seen the increase of this household credit in a period of our economy was stagnated, which was totally contradictory with the idea of the cycle. So I think, of course, I think this, the Minsky financial cycle is a reference that we have to use, but it's really important to also realize how we can just be different, considering a lot of aspects. And so when we consider the possibility of recuperation of our economy, it's very important to understand how the household financial fragility is nowadays, because it's really a very different impact as the mortgage credit is not so important, but for example, revolving credit card is becoming very important. So interest rates impacts are immediately. You mentioned the idea of medium and long term impacts when we talk about mortgage credit, but here it's the impact is directly and household budgets. And so I think it's so many different aspects that we have to consider here. And as the credit increase when the economy is stagnated, that maybe what we have here is not a credit that will guarantee consume of new goods, but it's a credit that is guaranteeing the day-to-day expenses of the household. So when maybe these new governments is trying to recuperate and to put the economy and growth process, it's maybe the fact that the households are really with a high level of indebtedness, it make it very difficult for them to answer to maybe to some policies that will try to stimulate the demand and the sales and etc. So I think it's some ideas that we are having here in our research, and it's a lot of challenges that we are facing. Thank you.
Thank you. I don't know if Carson, would you like to make a rejoinder?
Yeah,
sure.
No, thank you very much for sharing that experience. It's very interesting to learn about that. To me, this sounds really like the worst form of financial fragility you can imagine, because I think in Minsky, the focus was on corporate debt, but the idea is, okay, the firms occasionally take out too much debt, but they also they acquire physical assets, and the firms grow and they produce something and they make some profits, and that allows them to repay some of the debt. Sometimes that goes wrong, but you know, the whole thing sort of still can work for certain periods of time. And then if you think about mortgage debt, you could say, okay, this is also quite risky, but at the same time, the households do acquire an asset. And as long as the price of that asset goes up, which in cities like London it typically does, it's risky, but it can work. But if households take out credit just to finance their daily expenditures, I mean, this is very unsustainable because they don't acquire any assets that could increase in value. They don't acquire any assets from which they could extract profits in the future. So I can't really see how that can work for longer periods of time. And I think if you have a political model that is based on an expansion of credit to households for consumption purposes, I think it's a recipe for disaster. And then this is a sign that there's something fundamentally wrong in the economy. I think it needs to be addressed probably through redistribution and social policies. Yeah.
Thank you. I just for concluding comments, and I think that we have a sort of joint perspective that models are important, and so are case-by-case assessments of what we are discussing, particularly in terms of financial instability. I would like to make just one quick organizational comment that we had so far 4 seminars here in the Rio and Leeds Bridge seminars. The next one will be in the first Friday of the next month. We will approach a little bit of history of economic thought, comparing visions between the UK and here in Brazil, or more broadly, Latin American perspectives. And we will conclude this with the 6th seminar about labor economics in the other month afterwards. With those last comments, I would just like to thank very much for both presenters. This has been an excellent conversation, and I'd like to thank the audience as well for connecting with us. See you next time. Bye-bye.
Thank you.